Hi, good morning. I'm very happy with our performance, our team's performance in Q1. We delivered strong overall performance with great business results in almost all categories. Back in the previous quarter, myself and Ranga and Praveen had talked about focusing, putting in a strong focus on execution, and I'm really happy to see that we have been able to deliver that, and the results are reflected in our performance. We saw 3.2% revenue growth on a reported basis, 2.7 on constant currency basis, and we had good margin performance of 24.1%, despite many margin pressures, and I'm really happy about that. For 6 quarters in a row, we have improved our revenue per employee. It is now just a whisker below $52,000, and this has come on the basis of strong utilization. Our utilization crossed 84% overall, and including freshers, it's 80.2%, which is the highest level ever. The 84% without freshers is the highest level in 15 years, and the 80.2% is the highest level ever. We also had very strong adoption of automation, our NIA platform, by our delivery teams, that led to the saving of several thousand people's worth of work in our delivery team, as well as the strong adoption of automation and AI in our client base. We had very strong performance in cash generation and our cash position. Ranga will talk about this in more detail. So overall, I am very happy with our performance. Starting this quarter, as promised earlier, we are revealing the new high growth services that we have been focusing on over the last couple of years. So there are 6 categories of new services in the cloud AI centric area. I'm very happy to report that compared to 2 years ago, when these services did not exist, we have seen strong growth in these. Going forward, we will obviously count on strong growth coming from these services. And in the last 2 years, the roughly $2 billion in revenue growth that we have seen, half of that has come just from these new services. So this is something that, as we transform our company on the basis of emerging services, of renewing our existing services on the basis of automation and our grassroots innovation. Earlier, I drove here to this venue in our own indigenously built golf cart, autonomous golf cart. This is a test bed that we have built to train thousands of engineers in autonomous driving technology. As we renew our existing services on the basis of these dual forces of automation and innovation, powered by our ability to teach ourselves, and growing into completely new areas, both in new services and in new software, that I'm really proud of the work that our teams are doing. Thank you.
Good morning, gentlemen. Nishant Sir from the department. I think that's it. Yeah. So my first question to you, Mr. Sikka, is can you elaborate on the segments that have contributed to the positiveness that you have shown in the guidance? And also, what kind of impact do you see of wage hike on the margins? To Mr. Praveen, can you give us a sense of the net hire at the end of Q1? Mr. Ranga, to you, have you factored in wage hike in the margin as well? And how do you aim to set off the impact of rupee appreciation, visa, and as well as a wage hike as well? And lastly, can you give us the total contract value you have garnered by the end of Q1? Thank you.
So Praveen can talk about the segment performance. We had very strong performance overall. Our core delivery business grew faster than the company. New services that I mentioned earlier, these high growth services contributed 8.3% to our revenue, and the new software, so again, software that did not exist 2.5 years ago, has contributed 1.6% of revenue in this quarter. So these are clearly very high growth areas, future oriented areas for our clients that are happening, and Praveen and Ranga can address the wage hike and the margin pressure.
See, on the segment side, it's been fairly broad-based. Obviously, we had very strong growth in ECS vertical, led by telecom. Telecom grew on a constant currency basis by over 8% on quarter-on-quarter. This was led by a lot of wins around consolidation and M&A activities. Similarly, in the utility space, we continue to see good traction. There is a lot of investment in focusing on green energies, customer service, modernization, sensor-based metering and so on, and we have been able to capitalize on those opportunities. Energy in this quarter we have seen good growth in energy after a long time on the back of some of the ramp-ups of large deals we have won in the past few quarters. But going forward, we believe that given the volatility in oil prices, the energy sector will continue to remain sluggish. In Americas, we are seeing a lot of focus on energy companies on driving utilization, improvement in efficiencies across the value chain. In Europe, we are seeing an interesting trend where we are seeing mid-tier energy companies trying to take advantages of the volatility in the oil prices, and we are seeing some opportunities in the greenfield areas in trading and other spaces. Financial services, we continue to see good traction. The growth has been on the lines of what we expected. Our competitive positioning remains extremely strong in this space, and it has allowed us to capture market share in this space in the last few quarters, and we continue to remain optimistic. While we have had good growth in retail this quarter, we expect the volatility to continue. Given the strong currency, US dollar, some of the global retailers and CPG companies are getting challenged because of the strong US currencies, and they are focusing a lot more on cost takeout. There is a lot more focus on omni-channel and supply chain opportunities there. In manufacturing, overall growth is moderate. We are seeing uptick in engineering and in industrials. In auto, it's a little bit muted. High-tech continues to be soft, given that most of the companies in the high-tech space is moving away from a high-margin license-based models to a relatively lower margin subscription model. So there is tremendous focus on cost takeout, and we are seeing some slowness there. But barring that, overall, it has been a fairly good growth across segments.
Thanks, Praveen. As Vishal was mentioning, on multiple fronts, we have had a very satisfying quarter. Apart from the revenues, if you look at the operating margins, 24.1 has been resilient. I'll talk about it in more detail later. Likewise, the net profit margin has been at 20.4, and we had a very strong operating cash generation of $644 million. And consequently, our cash balances have been at the highest at 6.1 billion and 39,000 crores, highest ever. And the other key factors that I'd like to emphasize is if you come to operating margins, we had indicated and we have retained the 23 to 25% band. If you look at first quarter, our operating margins have been at 24.1, same as Q1 of last year, and sequentially it has declined by about 60 basis points. This quarter, we had the rupee appreciating, if you look at it on an average basis, about 3.5%. That impacted the margins by about 80 basis. At the same time, we had some cross-currency advantages, which kind of offset to the extent of 20 basis points. More importantly, I think, as Vishal said and Praveen said, we had a very robust utilization of 84% as compared to 80% same quarter last year. And including trainees, it's 80.2 as compared to 76.5% same quarter last year. So there have been substantive movements that gave us a positive impact of about 90 basis points. Then, as always, we wanted to make sure that all these gains are given back to employees. We announced a very healthy variable pay across levels that impacted by approximately 1%. Then again, we had higher some subcon costs this quarter. So net, I think the margin sequentially declined by 60 basis, but however, if you compare with the Q1 of last year, it was steady at 24.1. So as you know, we'll be announcing the compensation hikes, and we're also ramping up the US talent model. And rupee continues to be uncertain, so we need to watch. So that's why our band remains as 23 to 25. So that one particular thing remains. And again, coming back to the other factor I would like to point out, you asked about the net headcount addition. This quarter, again, the net count addition has been negative, which is minus 1,800 people as compared to plus 3,000 people same quarter last year. So in other words, if you look at year on year, our headcount has grown by 0.8%, whereas the revenue has grown by 6.3%. So that's pretty much reflected in the per capita, rather the revenue per employee. So I think these are the broad parameters on multiple fronts. We'll continue our relentless focus on operational efficiency and cash generation. If you look at this quarter, for example, the on-site employee cost as a percentage of revenue, if you compare to same quarter last year, came down. Now it is 38.5 as compared to 39.3 same quarter last year. Subcon went up, but primarily because of higher utilization, that's and to some extent on-site demand. Then similarly, the overall employee cost as a percentage of revenue also came down as compared to last year. So we are kind of looking at intensifying the focus on efficiencies and as well as the automation. Finally, we believe that whether it is automation, etc., it has to reflect in the P&L. Otherwise, we need to see those impacts on the P&L. However, at this point in time, we retain our margin guidance on account of both rupee part as well as our US talent model part. And also, we'll be rolling out the compensation hike. So in the subsequent quarters, you'll see some impact of those.
Thank you, gentlemen. Kritika Saxena from CNBC TV 18. To Vishal, you have increased your dollar revenue guidance, but given the beat in the first quarter, why not increase your constant currency guidance as well? Are you being cautious? Is there any form of weakness expected in the coming quarters? And you had reiterated last time that by the second half of FY18, you are expecting a pickup in the deal pipeline. Can I then expect that you will be upping your guidance then? To Praveen. Praveen, last time you spoke about consulting, retail and BFSI being soft. You already spoke a bit about BFSI and retail, but can you give us a timeline as to when the recovery will kick in? Even in terms of consulting, European consulting business was being repurposed, which will take about a year. Has that, have the benefits of the repurposing kicked in yet? And in terms of manufacturing, what is the reason for the slowdown in this quarter? Are there any concerns there? Ranga, you're moving to US, I believe. What's the reason for that? We only know in the press release that it's business reasons. I also wanted to ask you a bit more on wage hike. You spoke that there will be an impact of wage hikes in the next quarter. Can you give us a quantum as to how that would impact margins next quarter? And even a reiteration on your capital allocation policy, as Vishal pointed out, what would be the details in terms of what quotient would be the dividend, what quotient would be the buyback? You've said FY18, when in FY18? Thank you.
So now I have forgotten what your question was. Guidance. So when it comes to guidance, I have always said that we say it like we see it. As we see the business environment emerge in front of us, if we see a reason to change things, then we will. We see positive signs everywhere. However, as you can see, as Ranga mentioned, our net headcount has actually slightly decreased. Our revenue per FTE, revenue per employee, has increased for 6 quarters in a row. So clearly, all the strategy levers that we have been working on, automation, renewing our services, a strong focus on operational efficiency, on adoption of new services and new software, all of these things are working. We are now approaching $52,000 in revenue per employee. So this is how the transformation will take shape. This is how the transformation that we have been working on for the last 3 years is emerging, and it's taking place. When it comes to quarterly guidance and so forth, right now our focus is in this climate to ensure an absolute relentless focus on execution. That's what we are working on. And once Q2 is done, if we see a reason to change the guidance, then obviously we will do so. When we, will say it like we see it, if at the end of Q2 we see things differently, then of course we will let you know.
Okay. On consulting, as we said last time, this is a 1-year recovery plan. We have just completed 1 quarter, and so far it's tracking to whatever our plans are, and we remain optimistic about it. And fundamentally what we are trying to do is we are trying to repurpose the consulting focus from traditional ERP implementation and consulting services around packages to focusing on new services where we are seeing a lot of opportunities, and that journey is underway, and we are very happy with what we have seen in the first quarter. On the manufacturing side, as I said earlier, if you break down into individual subsegments, we see fairly decent growth in the auto space. We are seeing moderate growth in the aerospace, but high-tech is where it's relatively soft, and we have a big exposure to high-tech. and that is in fact resulting in probably a fairly moderate growth in manufacturing. And we expect this to continue for a period of time, particularly on the high-tech side, because if you look at what is happening in the high-tech space, fundamentally you are seeing companies moving away, shifting away from a license-based model to a subscription-based model, and typically license-based model is much more profitable than a subscription-based model. So they are under, there is restructuring going on in the client organization. They are focusing on cost takeout, efficiency improvement, and so on. So it will take a while for us to recover on the high-tech space, but it's a mixed bag. But we remain fairly optimistic about this space over a period of time.
Yeah, coming to the operating margin question, while we have kept it at 24.1, it has been resilient in Q1. As I said earlier, we have to watch the rupee closely, and we have announced the compensation hikes plus the ramp up of the US talent. So we reiterate 23 to 25. So our announcement of compensation close to about 1% would be there in terms of the operating margin impact going forward. So that is one part. Let's say you can expect that in Q2, for example. So of course, there are other levers that we'll continue to focus on operational efficiency improvements. Coming to capital allocation policy, as we reiterated earlier, company reiterated its commitment to execute that capital allocation policy in a timely manner in this year itself. As you know, we are a globally listed company. We have a large global shareholder base. So the distribution mechanism requires certain regulatory approvals, which we are working on. So as soon as that is there, the mechanism will, something that we want to finalize. So there is a commitment as given by the company to make sure that it is executed and implemented in this fiscal itself in a very timely manner. Coming to that point, I think next couple of quarters, we have to focus on the talent, US talent model execution and many other pieces. So I think next couple of quarters that is necessary. So that's what be the reason.
Maybe I can address that as well. So as you know, Ranga. Oh, Ranga is more than a CFO. He is. So Ranga and I worked very, very closely together in my early days. For 5 or 6 quarters, Ranga was based in the US, and we used to work extremely closely together. And we want to get some of that back. And as you know, we are hiring 10,000 people in the US. We have already hired 600 out of those. We are opening up new centers. There is a significant transformation happening, and the nature of this transformation itself is quite different. So I need Ranga closer in the US. So this is why he's moving back.
Next couple of quarters.
For now he's moving to the US, and obviously we'll see how it goes.
Ranga luckily got his visa.
Maya Sharma from NDTV. With Donald Trump's heavy Buy American, Hire American moves, how much of a challenge is it for Infosys? And do you expect any kind of cutback in growth this year and the next few years? And I know, Mr. Sikka, you described yourself as a local hire, but you've already mentioned some figures. But how fast will this hiring be done of local talent? And were you disappointed that Prime Minister Modi did not raise the visa issues with President Trump?
Not at all. So I think that all of these point to one underlying reality, which is it is not so much about the visas as it is about innovation, about the changing nature of the workforce, about the changing nature of the priorities of businesses in this time. If you look at the American companies, we are in the throes of a massive digital transformation. The kinds of services, the kinds of capabilities that businesses need in this time are all about being close by, being able to work on next generation technologies rapidly, bringing together local talent with the best of global talent in new ways of working and so forth. So we already saw this coming. We launched the first of this hiring in 2014. About 2 or 3 months after I joined, we launched a program to hire 2,000 people in the US. That program was quite successful. We managed to do that more than 2,000 over the next 12 months. At that point, we started the US Foundation, which has done incredibly inspiring work in bringing computer science education to the masses in the US. And so the third phase of this, which we have in fact been working on for more than a year, is this 10,000 hiring plan. It is not so much motivated by visas as it is motivated by the changing nature of work, the changing nature of demand, and the nature of services. So we are absolutely committed to that, and I believe that, and the numbers are We have talked about 10,000 people. In Indiana, we plan to hire 500 in the next 2 years. Similar numbers in North Carolina. So we'll hire 2,000 people in Indiana over the next several years, and similarly 2,000 people in North Carolina over the next several years. And we expect that there will be 2 or 3 additional hubs in the US that we will establish as we go forward. So which is another reason why Ranga needs to be closer there.
Hi, Chandra Shrikant from ET Now. Vishal, I'm going to start with you. This quarter has been better than expected, but if I look at the correlation with volume and pricing, volume growth is pretty much flat, pricing is improved. So should we see this as a 1-quarter improvement, maybe because of some milestone payment that's come in, or is it indicative of a broader recovery that you're seeing in demand? Secondly, this quarter also there's been buzz that, the promoters may want to sell their stake in Infosys. What's really happening to resolve that overhang? Because it continues to be an overhang on the company, on the stock. Are things more amicable now between the promoters and the board? Praveen, I didn't get the TCV number. So if you can give us the TCV number, how close are you to that $1 billion target that you had? Also, TCS mentioned that they are seeing very mixed trends in BFSI and retail. Considering these are important verticals for you as well, is it a secular trend, or are you seeing things differently? Ranga, you mentioned some approval spending as far as capital allocation is concerned. Will these come in by Q2, a timeline that you can give? And this quarter you've been able to sort of improve margins, but with wage hike coming in, do you still have headroom as far as utilization is concerned, or is this your optimal number? Thanks.
So, Chandra,
Vishal, I hope you haven't forgotten the questions.
No, I wrote it down. I turned 50 recently, so I have to start doing these things. No, in terms of the volume, so there was no one-off thing. This is a broad-based growth and strong growth. I wouldn't even say purposeful growth, because we grew in the new areas far faster than in the older areas, more traditional areas, which is exactly how we want this to be. If you look at the volume and realization situation, the volume growth was around 1.7, 1.8%, and we also had a good strong effect of pricing realization this quarter. The realization improved slightly again, and Ranga will talk about this in more detail. So I attribute this to strong execution, to strong high utilization, more purposeful growth where the volume growth does correspond to revenue growth, and the adoption of automation, the adoption of new software and new services across the board. And on the other matters, I think that, as you can see from our execution, when we are focused on execution, good things happen when our team delivers, when our team is focused on the business and is delivering to that, then great things continue to happen. And I think that my own sense is that the promoters are incredibly distinguished people, and whatever they decide to do is something that I believe will always be in the interest of the company, and something that I personally always have a high trust for. But I don't want to comment on that any further than that.
On the large deal front, it's on similar lines like last quarter, slightly under one. Yeah, around 800 plus, similar numbers. But like consistent with last quarter, a big percentage of it is renewals. So going forward, our belief is this metric will probably be less relevant, because we have now started focusing on new services and new software. And as Vishal talked about, if you look back about our growth over the last 2 years, more than 50% of the growth has come from new services and new software, and we'll start focusing more on those.
TCV, is there a breakup you can give between traditional deals and some of these newer services?
I think it's less relevant going forward.
Yeah. I mean, the new services will typically be more on newer technologies, new space and other things. Large deals are typically associated with infra, BPO and those kind of things, whereas new services will be in an entirely different way. It's more development oriented, new technologies and so on. So our belief is our future, we are betting hugely on the new services and so on. While we'll continue to be competitive, we'll continue to win, compete very strongly and winning our fair share of large deals and other things. But our belief is over a period of time that will be less relevant, and we want to focus much more on the new services and new software, and so that's why we are not talking too much about it. And on the retail and BFSI, and retail again, while this quarter we had a good quarter, but we expect it to be volatile. We have also seen at the same time one of the highest layoffs and store closings, particularly in Americas and so on the retail space. So there the competition is very intense, and with strengthening dollar, global retailers as well as CPG companies are also challenged. There continues to be focus on cost takeout and reinvestment in supply chain, reinvestment in omni-channel and so on. So there are times when we will see spend coming, and we are confident we'll be able to pick up our share, but we expect this trend of volatility to continue. I mean, it's very difficult to predict what will happen in retail space. BFSI, it's our performance this quarter relatively was lower than when you look at the track record of what we have been doing in this space, but it seems similar to what we expected. We strongly believe that we have a dominant position in this space, and we have been able to capture the market share over the last few quarters. So we remain optimistic about this. We are seeing stronger growth in rest of the world and Europe, relatively moderate growth in Americas. There is an expectation with the increased interest rate and less focus on regulatory thing that spend will start coming back. Our belief is it will probably happen sometime in the second half or something, but we have to wait and see. We have not seen any signs of it, but there is a belief that we'll start seeing some spend, at least in the Americas, also kicking in sometime later this year.
Hi, coming to the pricing point that you raised, I think though sequentially it has gone up, the more better and true indicator would really be on a year-on-year basis, because quarter to quarter there could be some volatility on timing differences and things like that. If you look at year-on-year, it has been flat in the sense that, in fact, in constant currency basis, it has slightly declined by 0.2% on a year-on-year basis. So that's on pricing. So coming back to the capital allocation policy question that you raised, we reiterate our commitment to execute that in a timely manner. As we are a globally listed company and very large global shareholder base, the mechanism of distribution requires certain regulatory approvals. And it is, AOA is only one part, but there are certain regulatory approvals that we need, and we are kind of want to make sure that, as we have given a commitment to our shareholders, we want to close it as quickly as possible.
Just one follow-up on this. Are the decisions of the promoters weighing on your minds? Is that why you're holding off on your capital allocation policy?
Absolutely not.
Are you waiting for them to take a call on what they plan to do?
As I said, it is a regulatory approval, so it is nothing to do with any other aspect. So we are following it up, and as soon as we have an outcome there, we will quickly execute in a timely manner.
Also, utilization 84% it was part of my question.
So coming back to your other questions, see, for the operating margin, we are given a guidance of 23 to 25, though we ended the last year at 24.7, right? Almost 1.7 decline we have shown. But the reason that we have indicated that way was taking into account both the rupee part, the US talent uptick part, and some of the other, those were the key pieces. First quarter, yes, we have been resilient in maintaining our margins on the back of very strong utilization. Most importantly, even the on-site employee cost as a percentage of revenue, total employee cost as a percentage of revenue. And also, we have been prioritizing our capital expenditure. If you look at this quarter, our capex was about 85 million as compared to about close to 130 million same period last year. So we are prioritizing, we are optimizing. So having said that, I think if you look at our on-site mix, still high, it is crossed 30%. So we need to work on moderating it. Likewise, we need to look at the on-site role ratios and see to what extent this net headcount addition, the per capita revenue that Vishal talked about, how much does that play out and help us. So these are all the factors that we have taken into account in keeping 23 to 25. So there are levers. It is not that we depend on only one lever. There are levers, because I distinctly remember when we were at 80, people said, look, 81 is high, how come? But I think we are also at the same time very cognizant of the fact that these levers at the same time have certain plateau, but we have to work towards overall optimization and on multiple fronts. So we are at it.
Thank you.
Very good morning. My name is Sakshi. I'm from Z Business. Vishal, my first question will be with you. First of all, many congratulations for the recent award that you got for Best CEO, and to the whole team also to also to Ranga. Many congratulations on that front, and good set of numbers. A big sigh of relief, no unexpected execution challenges like last time. So I just want to ask you, Vishal, first of all, what kind of contribution from the new services have you got in this quarter? And since your arrival was in a good style in an automated car, can we see that this is an indication of a complete shift to automation, and going ahead we will see some meaningful contribution to the top line from these new services? If you could please elaborate on that. Praveen, my question will be with you. Looking at positive attrition numbers, even this time you've got 16.9%, which is a tad bit lower from the previous quarter, which is again a good point. So going forward, do you see any further room of reduction in attrition numbers as well? Ranga, first of all, on the operating margins front, we've maintained the guidance of 23 to 25. We agree that there have been some pressures relating to visa costs and rupee appreciation, but were there any sort of cross-currency tailwinds this time to support you? And going ahead, what kind of margins can we expect, a revival further from 23 to 25%? Thank you.
Thanks so much. Actually, first of all, thanks for the kind words on the award. It's actually all the work of this extraordinary work of our amazing finance team. Ranga was the best CFO, both from the buy side and sell side analysts, and we won several awards for our finance and investor relations team. So very proud of that. On the new services and new software, this is what we are really strongly focused on. So when we look at the new services, they are in 6 different categories. These are all these cloud first, AI first categories. We have this quarter 8.3% of our revenue has come from new services and 1.6% from new software roughly. So that's altogether about 10%. Now when you look at this, these are services that basically did not exist 2 years ago. And if you look at the revenue growth that we have had in the last 2 years, that's about $2 billion. So that means half of that revenue growth has come from new services that did not exist more than 2 years ago. So this is why we are so committed to these, and these are our high growth services that our clients care about. These are about the future technologies, such as autonomous driving. And when it comes to these new technologies, there is always a curve of emerging technologies just over the horizon. If you look at these days, voice technologies, chat technologies, virtual reality, augmented reality technologies, as well as the strong adoption of AI-based services and AI-based applications, these are the areas that we want to work on: cybersecurity, modernization of legacy landscapes to the cloud, next generation analytics, and integration of the physical world into the digital with IoT and so on. With regard to the autonomous car, Sebastian Thrun said recently that the going rate for an autonomous car engineer is several $1 million. And I was talking to him about this, and we created a program within Mysore to teach our engineers autonomous driving technology. And as a part of that, our team, Sudeep's engineering team under Ravi's leadership, built this, have indigenously built this, and something that we are really proud of. It is more a mechanism for us to teach our engineers how to build these technologies and so forth. But it is more than anything else a symbol that we can be on the cutting edge of these technologies as good as anyone else.
On the attrition front, typically Q1, we expect higher attrition because a lot of people leave for higher education. So we expect today in Q1 our attrition was 16.9%. We expect this to come down in the subsequent quarters. And we also closely track high performance attrition, which is much lower. It's about 11.4% or something, much lower than the overall attrition. So we don't have too much concern. We continue to focus on reskilling our employees, engaging them with a lot of employee-oriented activities, and that focus will continue.
Yeah, coming to your questions on margins, if you look at the last 2 years, we have been successful in keeping it very resilient. It was in the band of 24.7 to 25 last 2 years. And despite multiple headwinds that we saw in the last 2 years, whether it is on volatile currency because of Brexit, or the pricing, or even the compensation increases on multiple fronts. So we held it very resilient last 2 years. Now, last year we ended at 24.7. This year we guided 23 to 25, and we indicated that primarily on account of rupee we need to take care of. At the same time, we want to invest on the US talent model, plus of course, the compensation. Of course, first quarter, our margins have been stable, same period last year, 24.1, 24.1. And at the same time, it has been possible because of the very strong focus on the operational efficiencies, which I talked about, the utilization at 84% as compared to 80% same period last year. Even including trainees, it is 80.2 as compared to 76.5 same period last year. Now, we'll continue to focus on these, clear operational levers. At the same time, you're also aware that we have compensation increases coming up. We also know that the rupee is something that we need to watch. So taking into account, though we have 24.1 in Q1, and our band remains as 23 to 25. And we're also prioritizing the capital expenditure and a couple of other areas where, without diluting the investments for growth that is required, we don't want to dilute that. Without diluting that, what are all the measures we want to optimize? I think another highlight of the quarter, as I said earlier, is a very strong and healthy operating cash generation in terms of better collections and other measures. So I think that is a strong focus area, which has led to highest ever cash and cash equivalents and liquid assets balance in the balance sheet, 39,000 crores and $6.1 billion. I think we'll continue our relentless focus on both efficiencies and which can reflect in margins as well as a strong generation. However, we reiterate our margin guidance between 23 to 25 because of these additional pieces that I talked about.
Thank you, gentlemen.
Yeah, yeah. Chris, just one clarification really on the ramping up of US talent. When the new DCs were announced, really, the timeline that was given to hire was, about 5 odd years or so. But in terms of the pace of hiring, what kind of numbers do you see annually happening? And Ravi, out of the 4 or 5 that you said would be opened in US, when exactly, or what is the timeline when we can see all the 4 centers operational?
So thank you. So here is what we were doing in the US talent model. We otherwise hire in the US. We hire for our client locations wherever we have projects. So this endeavor was to hire for centers, which we actually said we're going to hire for, and convert our model into a on-site offshore model to an on-site nearshore offshore model. And these centers were those technology and innovation hubs. So we said we're going to do 10,000 in 2 years, and potentially 5 centers. And our criteria of the centers was we would look for client clusters, good local academic ecosystem, because we're going to hire a good number from schools locally, and government support. So we did Indiana in the month of May. We did North Carolina in the month of June. We are now going to shortlist the next few centers as we go forward based on those 3 criteria. The idea is to hire from schools locally, to repurpose and refactor talent from adjacent capabilities, and to hire experienced talent. So we're kind of replicating the model we have in India in the US. We've already done quite a bit of hiring in the first quarter, both from schools and experienced talent. And we have now started doing training in the US. So last year when we hired campus hires in the US, we actually got them to Mysore. Now we are locally training them in the US. So our endeavor now is going to be to locally train, locally build that capability pool, and cater to the clients in an on-site nearshore offshore model. So these nearshore centers would almost become the technology and innovation hubs, because work has become much more agile, much closer. The newer and the modern work and the new services which Vishal spoke about is much closer to clients. It's much sticky, and it's actually shorter sprints. So that's the plan.
So you're actually in no hurry to really open all the centers in the next 1 or 2 years?
No, we are going to open. We are going to open in the next few months as we go forward. But we will continue that process of shortlisting, talking to the local government, working with the academic institutions. So you're going to see more announcements of the next 3 centers. And there will be, pretty much we're going to do all of them in this financial year.
There's been a lot of talk on the compensation being rolled out and the hikes as well. I mean, I want to hear from the horse's mouth really what kind of hikes have been rolled out this year, and also a few, J6 and above is what we heard, have not been told whether they're going to be given a hike or not. Some clarity really on that.
No, I think, for example, from 1st of July, we rolled out the compensation increase for all our mid to junior level people. And I think these have been very differentiated based on performance and various other metrics, skills, utilization. We've looked at everything. And there's been, like, for example, significant number of people have got double-digit increases, while at the same time there have been some who've got no increases. Yeah, so it's been quite differentiated. So we've rolled that out from 1st of July. For the other levels, I think we kind of look at it in a staggered way. For the more senior levels, I think we'll take a call as we go, as we see the business and the visibility, and I think we'll come back with further details on that. But that's all clearly in our consideration. I think talent is very important to us. I think we want to ensure that the focus for us is really ensuring it's performance based. So I think we've really, in the last year or so, we've focused a lot more on ensuring that there is differentiation, there's more focus on merit, and that our high performers as a group continue to really stay with us. So I think that would continue as a focus. And I think for the other levels, we'll announce over time.
Sure, Ravi, just sense of really the client environment in the US currently. The buzz was on how probably, client-side spending, the pickup has been quite slow, and even the discretionary spends for clients is a little muted. What is your own sense when it comes to the clients out of US, and what do you hear?
Sure. So what I'll do, I'll start and I'll ask Mohit and Rajesh to add on the view from their industries. I think there's no particular upswing or downswing, I would say. It's a fairly stable environment. There are a few sectors which are continuing to change their spend. For example, financial services, banking and financial services. The expectation is there's going to be much more spend on the non-regulatory areas because of the new administration which has come in. Retail is under pressure, as we know. We all know that the retail sector is under tremendous cost pressure. So I really don't think there has been a significant shift either ways. What really has changed is the spend on new technologies and the spend on digital and the embrace of digital across industries is much more broad-based in comparison to the past. So every industry is figuring out what can they do to leverage technology. Every industry is actually putting a digital agenda. Every industry is actually putting an agenda on how to actually generate a revenue stream leveraging technology. So that to me is the big bet. Every industry is spending on securing their digital infrastructure. So most of our customers are spending on, say, cyber security. So that's a very common thing across industries. So Mohit, maybe you want to add a little bit, and Rajesh.
Thanks, Ravi. So look, I think Ravi's sort of said it quite eloquently, that it is not that there is a huge cutback or a change in spend. The fact is that the role of technology now is even more important than it ever was, right? And I feel that our software plus services story is really resonating very well in the marketplace. Having said that, obviously in financial services, for instance, while we've had a moderately good quarter in line with expectations, we'd shared last quarter also the fact that we feel that because of the interest rate hikes and because of the change in the regulatory regime, we hope that the spend will come back in the second half of our financial year, and we're still holding to that assessment. Our competitive position is very strong. We've done extremely well overall in terms of strengthening that, and the areas where we're focused, right, the automation space, the digital space, the data space, these are the areas where our clients are spending. So while we have seen a greater sort of increase in revenues from a Europe perspective and from an ROW perspective for financial services, the US remains a key market for us, and we remain very optimistic about our long-term and medium-term objectives there. As far as insurance is concerned, I think Praveen mentioned this as well. On a year-on-year basis, we've seen something like 19% growth, right, which is truly spectacular and truly market-leading. In other sectors as well, I think Ravi spoke a little bit about retail. Retail is in the middle of a very significant transformation. Many of our clients are traditional retailers, so they're obviously feeling the pain, but equally they are orienting their businesses towards more of the digital and AI-led worlds, and that in the long run will have a very positive impact for us. All the work that Ravi and his team have done on the US talent plan also goes a very long way towards convincing our clients that we're a global company and that we can be a strong local partner for them also in the various parts of the US. Rajesh?
Thanks. If you look at the energy, utilities, telecom space, I think for us the telecom business has grown really well. Year on year, we've had close to 15% growth, and I think it has come on the back of fairly significant consolidation which is happening in the industry. We've seen a huge number of mergers and acquisitions happening, and in that space, when consolidation happens, the higher tier vendors get an opportunity to increase their wallet share, and that's really what has happened. The telecom companies themselves are, of course, struggling. Revenues are not growing, and ARPU is falling, etc. And they continue to make investments in better infrastructure, in 5G, and so on. So I think there are a lot of niche areas where we are able to bring our software story in as well, and automation. I think that is helping our game there. If you look at the energy space, while this quarter has been a good quarter, we do expect the year to be quite sluggish. The growth this quarter has primarily been on the back of ramp-ups which we've seen this quarter because of deals which we won in the last couple of quarters. But clearly, because of the fluctuation in the oil price, we are seeing extreme focus on cost, and we are seeing that the spending is again on a wait and watch kind of perspective. Oil prices have been up and down quite a bit. If you look at the in the European space, because of the change in fluctuation, we are seeing a lot of the mid-tier trading companies using this as an opportunity to make fresh investments and do greenfield implementations, and I think that's a great opportunity for us. Utilities in Europe, we are seeing this trend about the separation between the retail part of the business and the generation business. That is creating a lot of opportunities for us. So overall, I think this year so far we've seen this quarter has been a growth of telecom and a growth of energy, but for the rest of the year I believe that energy will be relatively flat. We still expect that there is still more opportunities to be harnessed in the telecom space. Thank you.
Yeah, morning gentlemen, Nishant Desai from Bloomberg Coin. I want to understand what kind of uptake you are seeing in the financial services and the energy space as well, and yeah.
I'll leave with financial services and then I'll let my friend Rajesh talk about the energy space. So look, financial services, we've had a moderately good quarter, right? I think this is in line with expectations, 2.6% growth on a reported basis, and very strong growth in Europe, very strong growth in the rest of the world. From a US perspective, growth has been relatively muted, but we had shared this earlier as well, that we feel that the impact of the interest rate hikes is starting to be felt in terms of the increased profitability of the banks. We feel that the regulatory burden is lessening and therefore they will spend more money on discretionary projects. And I'm still hopeful that we will see that in the second half of the year. While in the rest of the world, we've already seen that. I think the important thing though, right, I think the important thing is while you might see quarter-on-quarter fluctuations, the competitive position of Infosys in this industry is very strong. I feel that we have an outstanding team both in the markets and in delivery. Jasmeet, Andrew, Dennis, Atul, Jay, Kanan. We have a really strong team in the market, and that I feel will result in, along with the very powerful message that Vishal has sort of outlined for the strategy of the company, the new renew and the culture. I feel that our long-term sort of prospects there remain extremely good.
Actually, the Fed rate hike story really has been quite positive for the banking sector in Americas, but really the macro uncertainty over Trump is a big overhang. Is that really kind of reflecting on clients, especially banking, given the fact that every third month we are hearing if the man is going to be impeached or not?
You don't want to comment on the
no, really,
on the
but
political
the
side of it. No, I agree. Look, I don't want to comment on the political side of it, but it is a fact. Look, when there is uncertainty, clients delay decision making, right? That is very clear. And you've already seen that. We have started to see that with the large deals, right? That large deals are taking a much longer time to fructify. The overhang that is there about immigration means that clients are, thinking about models. We are seeing some increase in some places of, captives and, a degree of insourcing. On the interest rate hikes, you will understand, you mentioned that you're already seeing it in the profitability and revenue of banks, but even historically, right, there is a lag, right? There's a transmission lag between the time their revenues go up and their IT budgets go up, and we feel that that transmission mechanism is still working, and you should give it a few months to see an increase in tech spends. As people get more comfortable that their revenue basis is more stable, they will start spending more on technology.
So the transmission usually takes about 2 quarters?
I think so. I think it takes about 6 months or so before people people want to see 2 or 3 good quarters of revenue before they start looking at technology budgets. See, nobody really has a fixed annual technology budget, right? Like they did 10 years ago. They will look at technology budgets every 6 months or so, and I think after 2 good quarters, people start to get more comfortable that that the revenue base is stable, and therefore they can now start looking at more discretionary spend.
Also, what are the verticals that will see stark improvement as compared to this quarter as we move on?
So look, I think we mentioned the fact that we have done extremely well in in Rajesh's verticals. So whether it's energy, telecom, utilities, we have had a very strong performance. Insurance has done extremely well, 19% year-on-year growth. We have done very well in healthcare. Life sciences has been the growth has been more moderate. Retail, while we have done well this quarter, I think Praveen has also outlined the fact that that there are longer term challenges in the sector, right? I mean, a lot of participants in the sector are under severe stress. The same is true for the CPG business as well. So we are a little bit more cautious about what will happen to the sector longer term, even though it is an undeniable area of strength for us, right? I mean, you've seen this historically. We have been the #1 player in the retail CPG sector, and we are seeing a lot of traction in the European markets, right, which have not been that impacted by, by what is happening in terms of the dominance of Amazon in the US. The manufacturing sector, maybe I'll let Rajesh talk about it.
Yeah, I think manufacturing sector for the year we've seen there's some traction in the automotive space, renewed investments there, but otherwise, because of the high tech there is definite slowdown. I think there's a lot of structural changes happening there. If you look at some of the big OEM players, etc., they're really shifting their product portfolios, and therefore the investments which they are making is being skewed. So I think manufacturing probably will only see moderate growth this year as well.
Thank you, gentlemen.
Thank you.